Let me know when we're actually live. All right. Apologies to everyone who's been waiting for a few minutes. We had some technical difficulties. I've been sitting here talking to you all for about 5 minutes, only to find out that the tech guy didn't click go live. So he clicked go live. Can everybody hear me? Just go ahead and say that in the chat. Give my tech guy some peace of mind here. I'll wait so that those messages can come in. All right. So the title of this week's presentation is "What Happened in 1971," and I guess the subtitle kind of spoils it, in my opinion. What happened in 1971 was the death of Sound Money. It had already been dying for quite some time, but 1971 was the year that it finally died. So if we click into the to get rid of that title, you can see behind it there's a graph on growth in productivity and hourly compensation since 1948. So what that refers to is the red line is worker compensation. So that's wages that are provided in as a share of the value that they produce for the company. So worker compensation in 19 and then worker productivity refers to increases in things like technology, education, and so forth that made workers more productive individually. So a farmer with a tractor and a bachelor's degree is going to be more productive than a farmer without either of them. And that's the idea. Technology and education have improved worker productivity. And notice there's an arrow there on the chart. 1948 to 1972, worker productivity and compensation were essentially tied to one another. And what that means is worker compensation improved along with worker productivity, so wages were stable in their real value as to what they could purchase for people who were working a wage. But in 1972, both values they converge at the 90.84% value, which means that in 1972 workers were being paid 90.84% more than they were in 1948. And that's because they were 90.84% more productive in 1972 than they were in 1948. Pretty simple. But after 1972, the worker compensation essentially flatlined. And today, and in 2017, which is as far as this data goes, compensation was sitting at only 115% of 1948 levels, versus worker productivity, which was sitting at nearly 250% of 1948 levels. So as a share of the worker productivity, worker compensation, as in wages, have actually sharply declined, which to some degree explains the political motivations towards raising the minimum wage and fairly compensating people for their work, because people in reality are not being compensated in the same way that they were in those previous decades. I won't comment here on whether such compensation should be considered fair. That's not what the subject of this is. But the data do show that they are not being compensated in the same way as they were prior to 1972. And tonight we're going to get into some of the reasons why that's the case. So if you go ahead and click again, we have a slide titled Key Dates in U.S. Money. And so today we're going to take a little bit of a historical look at what has happened in the course of the U.S. dollar, and what lessons we can learn from history in order to examine our current situation. So if we click again, we see in the very first time that the United States, well, they weren't the United States at the time, but the very first time that the colonies had a currency it was in 1775. It was called the Continental Currency, and it was issued by the Continental Congress. After the American Revolutionary War began in 1775, the Continental Congress began issuing paper money known as Continental currency, or Continentals. During the Revolution, Congress issued $241.5 million in Continental currency. Now, keep that in mind. Continental currency depreciated badly during the war, giving rise to the famous phrase, "not worth a continental." That was a very common phrase at the time. It was essentially to denote something that was worthless. And by the end of 1778, continentals retained from 1/5 to 1/7 of their face value. And by 1780, the bills were worth 1/40 of their face value. So you can see between those dates there was quite a bit of depreciation. Congress attempted to reform the currency by removing the old bills from circulation and issuing new ones without success. By May of 1781, continentals became so worthless that they ceased to circulate as money. They became like paper, like the Venezuelan Bolivar. Now, people. There's pictures of them of just sitting in gutters. People making them into handbags and pieces of art because they're more valuable in that form than they are circulating, being spent as money, and that's what happened to the Continental. Benjamin Franklin noted that the depreciation of the currency had, in effect, acted as a tax to pay for the war, and that's also a very important insight, but we'll get into that later. The painful experience of the runaway inflation and collapse of the continental dollar prompted the delegates of the Constitutional Convention, this was after the Revolutionary War, to include the gold and silver clause into the United States Constitution, so that the individual states could not issue bills of credit, which was one of the problems that had caused the depreciation of the continental, could not issue bills of credit as in start their own banks and issue their own currencies. But they also could not, quote, make anything but gold and silver coin a tender in payment of debt, end quote. So the founders already had in mind that anything besides gold and silver coins were going to be pretty bad stores of value, and they understood that even in wartime, even in something that would be very extenuating, even in peacetime, all the time there was the temptation for the government to inflate the currency in order to make ends meet. But they learned the hard way that was a very destructive way to finance even a war, even when it seemed like there was no other way to do it. They learned that there were consequences, and they learned that the hard way. And so they tried to codify that in the Constitution. But a later Supreme Court ruling found that even though this provision applied to the states, there was no similar provision for the federal government. And so now the federal government does actually issue unbacked legal tender currency that is not gold or silver coin, and that, again, I would argue that has caused a lot of the problems we see now. But go ahead and click again, and we have, in 1792, there was a Mint Act passed, and the Coinage Act, or the Mint Act, passed by the United States Congress on April 2nd, 1792, created the United States dollar, not as we know it today, but the United States dollar as the country's standard unit of money. It established the United States Mint, and it regulated the coinage of the United States. The act pegged the newly created United States dollar to the value of the widely used Spanish milled dollar, Spanish silver dollar, saying it was to have, quote, the value of a Spanish milled dollar as the same as is now current. which was approximately 7/10 of a troy ounce of pure silver. So you can see, even shortly after the Constitution was ratified, they were already trying to create gold and silver coinage in order to circulate it, in order to avoid the painful consequences of inflation that the Continental had shown them. The act defined the proportional value of gold and silver as 15 units of pure silver to 1 unit of pure gold. Thus, the nation was put on a so-called bimetallism standard, and gold and silver flowed in and out of circulation as demand for the metals changed. So you've probably heard of the gold standard and the silver standard, but you may not have heard of the bimetallism standard, which essentially attempts to hold gold and silver as the standard at the same time, which is problematic because in order for that to happen, you have to set an exchange rate. If you're going to denominate, let me actually pick up one of my examples here. So this is a, oops, I dropped it. This is a Walking Liberty half dollar, and it contains approximately 1/3 of an ounce of silver. So what that was saying, what the writing on this coin says, is that a half dollar is exactly equal to 1/3 of an ounce of silver. That's how it was defined. But if you also create gold coinage that is denominated in a certain value, then people will try, and they will be allowed to swap out gold coinage and silver coinage of the same denomination, but the underlying metals, gold and silver, may have a different exchange rate as determined by the market. Gold may be more valuable or silver may be more valuable at some point in time. In fact, we have seen in history that multiple mint acts had to be passed every 20 or 30 years in order to update that ratio, in order to because what happens is the more valuable metal, which was usually gold, except I believe in the California gold rush, gold actually fell in terms of silver, and so silver circulated instead. But gold and silver, throughout the period where the bimetallism standard was in effect, the gold, sometimes the more valuable metal, which was usually gold, as I say, would be put into people's savings, would be hoarded, in some people's colorful language for that behavior. Some people would save the gold, and then they would spend the silver, because it had the same denomination, but it was technically less valuable. And so they figured out that they could save more value for the same denomination. And so people would save the more valuable metal and spend the less valuable metal. That's Gresham's law. Bad money drives good money out of circulation because people save the good money and spend the bad money. That's the long and short of it. And what happened, what they were trying to do was get gold and silver to circulate at the exact same time, but that's very difficult because people want to save one and spend the other. And so only one wants to circulate at any given time, and that depends on market conditions. So, as I said, several acts in the later years were required to amend this ratio so that gold and silver would both circulate as money. If this were not done, the more highly valued metal would be stashed, while the lesser metal circulated almost exclusively. So if we go ahead and click a couple more times, you can see the next major event was in 1873 with another coinage act. Some people have colorfully referred to this event as the Crime of 73. it was a general revision of the laws relating to the mint of the United States. Oh, apologies. 1861 referring to the demand notes, or so-called greenbacks. This was during the when the Civil War was heating up. During 1861, the first year of the American Civil War, the expenses incurred by the Union government much exceeded the limited revenues from taxation, and borrowing thus became the main vehicle for financing the war. Now, we already know that this is happening. If this is familiar to anybody in the chat, you should say it, because we already see this happening with the endless wars in the Middle East. The only way for that to be financed has been borrowing, because if people were taxed at the rates required to produce billions of dollars in bombs every year, I think public support for the war would dwindle very quickly. And so borrowing, creating more national debt for future people to pay back, has been the favorite method for politicians to continue the war. But even in 1861, when the Civil War was being fought, this was a known strategy, and this was one that they adopted. So Congress thus created the demand note, which was not redeemable for gold or silver, for precious metals, and thus the value quickly depreciated and badly depreciated. They tried to use it for paying soldiers in the field, but that didn't last long. It's another lesson in the perils of fiat currency. Fiat meaning, fiat is Latin for let it be. It essentially only has value because the government says it does, not because of any underlying commodity that it's either made of or that it represents. It's simply valuable because someone tells you it is valuable. And that's what fiat currency is. And then we move on to 1873. Like I said, it's also known as the Crime of 73. The Coinage Act of 1873 was a general revision of the laws relating to the mint of the United States. And here's the crime part. It abolished the right of holders of silver bullion to have their metal struck into dollar coins, placing the nation firmly on the gold standard. So this was the moment where we moved away from the bimetallism standard into the gold standard. Popular opinion at the time was, perhaps by just the way that it was, most people at the time thought that they were on a gold standard, even though technically they were on a bimetallism standard, because gold was the one that was circulating on a regular basis. And so silver wasn't often seen in circulation. But what happened in 1873 was that silver was finally nixed, was finally done away with as a form of U.S. currency. But the people who did were actually saving silver bullion and did want to have it struck into U.S. dollar coins could no longer do so, and so they saw themselves as being gypped by the U.S. government, that there was a promise that they had now reneged on, and so they saw this as, in later years, they began to refer to this as the Crime of 73. So we're going to jump ahead. This is, by the way, there's a lot more I could cover here, but we're going to jump ahead again to 1933. And in 1933, Executive Order 6102 was signed by Franklin D. Roosevelt on April 5th, 1933, and it, quote, it was forbidding the hoarding of gold coin, gold bullion, and gold certificates within the continental United States, end quote. This was a confiscation by the government of more than $100 of gold. So if you had more than $100 of gold anywhere in your possession, you were committing a federal crime. And the goal of this executive order was in an effort to stall the Great Depression. People had started to hoard gold as a means of saving money. Again, hoard is colorful language. They were really just saving gold. But hoarding is a word that people like to use when they don't like that particular saving. Like at the beginning in 2020, when people were hoarding toilet paper, it really just means they were buying a lot of toilet paper and not leaving much for anybody else. Under normal circumstances, we wouldn't call that hoarding until there's a lot of people who want it and only a few people who can get it. So hoarding is really this is colorful language. He's making an argument in the very phrasing of this executive order. But what he did was to forbid the saving of gold coin, gold bullion, and gold certificates within the continental United States, all but $100 per person in face value. And anything above that, you were required to submit to the Federal Reserve for the price at the time, which was $20.67 of what became, essentially at that moment, fiat currency, because in order to exchange that, again, back for gold, you would end up with more than 100. If you had $150 and you turned in 50, you couldn't obviously exchange that back and get your 150, because then you'd be committing a federal crime. So if you have $100 in gold, everything else that you've saved has become fiat currency that you can't exchange. So it effectively banned private ownership of gold bullion for anyone saving a significant sum, and that ban was not lifted until 1974 by Gerald Ford. The effect was to make redemption of dollars for gold almost entirely foreign in origin. So foreigners who had US dollars didn't fall under the executive order, and so they could exchange as much of their dollars for gold as they would like, and they don't fall under the executive order, but U.S. citizens did. And so all of the domestic gold hoarding ended at that moment, and it became foreign gold hoarding. And then finally we get to the very last thing I want to cover, the very last moment, which is 1971. The devaluation of the dollar. It's sometimes called the Nixon shock, because President Nixon, who caused the shock, did all of these things in such quick succession that it was terrifying to foreign markets. In reacting to nearly 6% inflation and a sudden influx of demand from foreign governments redeeming their dollars for gold, because at the time the United States was under what was called the Bretton Woods system, where all foreign currencies were pegged to the US dollar, and the US dollar was pegged to gold, because they were trying, the foreign currencies were trying to separate themselves from gold. But the US, when the Bretton Woods system was established, happened to have quite a bit of gold in the treasury, and so the U.S., when this system was established, decided that they were going to become the world reserve currency. And that has a political aspect to it too, because the decisions of the Federal Reserve to print money or to contract money out of circulation could then affect foreign currencies because they were all pegged to the U.S. dollar. But what happened in 1971, which is what I'm here to answer, was that President Nixon said this as part of an announcement. Quote, "I have directed Secretary Connally, who is the Treasury Secretary, to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interests of the United States." So, essentially, at that moment, he ended the convertibility of the dollar to gold. I mean, again, he said suspend temporarily, but it's not really temporary because here we are, 50 years later. Nixon is long out of office, and the temporary pause on redemption for gold still has not ended. It's almost like the lockdown, 2 weeks, and here we are a year later. But I don't want to talk about that right now. I want to talk about money. Uh, this was supposedly a temporary measure, so go ahead and click again. And now we return to the chart. Now we have the historical background to what happened in 1971. We saw the U.S. government in history struggling with the restraints that the gold standard placed on its spending. Most of the time, in the Revolutionary War and in the Civil War, were two major points in U.S. history where fiat currencies were tried and they failed desperately, as we saw. But they were tried because they needed to, or they thought they needed to finance massive war movements. And in 1972, the massive movement was not a war, but rather it was foreign governments all around the world, essentially almost at the same time, tried to redeem their gold because there were fears of the U.S. economy. There were fears circulating that the Treasury didn't have the gold that they said they did, and so they got nervous and they started taking their dollars to the bank. And then Nixon got nervous and said, "We don't want to be caught out over this, so we're going to temporarily suspend the convertibility of the dollar into gold." And we see that the U.S. government, all except for a period of a few weeks in 1980, which was another anomaly that I'm not going to get into, all except for a few weeks in 1980, the U.S. government has never had the proper amount of gold in order to exchange for silver, or in order to exchange for the dollars. So the dollars that have existed, I believe the price at the time in 1971, don't quote me on this, but I believe it was $35 an ounce. And that there have been far too many dollars in circulation for the U.S.'s stated gold reserves to match that, except for a few weeks in 1980. So there was a disconnect in worker productivity and compensation that begins immediately after the gold standard was abolished. Now, you might ask, why did it happen in 1971? Why didn't it happen in 1933, which is technically before the chart starts? But why didn't it happen in 1933 when FDR banned the private ownership of gold? And that's because the certificates that were circulating in the economy were, and this is where we get the expression, as good as gold. They were traded because people had the faith in the U.S. government that they had the gold they said they did, and so they could trade this promise for gold just as if it was a piece of gold itself. But in 1971, that trust was broken, and a disconnect between worker productivity and compensation begins immediately after the gold standard was abolished, because then even the relatively large foreign demand for gold that totally exceeded the domestic demand for gold, thanks to the gold certificates that circulated in the domestic economy as a substitute for gold. In the foreign economies, they actually redeemed them for gold so that they could trade them in for their own currencies. That was where the demand came from, and that was why in 1971 the foreign demand ended, and thus this break occurs in 1972, the very next year. Workers in 2014 were paid 115% more in real terms than in 1948, but their productivity had increased by nearly 250% in that time, thanks to improvements in technology and education. Notice also that the minimum wage increases in the intervening time did little to break either trend. The minimum wage increased several times in the period between 48 and 72, and several times between 72 and 2017. And we see essentially no effect on either trend, either the coupling before 72 or the break after 72. So it didn't help workers' wages in either sense. In real terms, it didn't help real wages. But given the strong correlation between metal-backed money and wage improvements, which we see before 1972, a compelling argument exists to return to sound money to improve the livelihood of average working Americans. Imagine if we could increase the average working American's wages by nearly 150% of the 1948 value. We would see recessions that we know today would be absolutely crushed by that level of productivity and by that level of compensation increase. Very few people would be hurting in the same way that they are today if they actually received the compensation for the productivity they provide. And again, I want to get on my last slide. I want to get into the there's this chart here, and it refers to it brings the political aspect of the gold standard into sharp view. You can see there are two circles on the chart. Well, actually, they're ellipses, but there are two areas highlighted on the chart, and they're both labeled having to do with populism. Now, populism is a political strategy that refers to the red line tracks the percentage of wealth held by the bottom 90% in net worth of the U.S. population. So you can see that's the line on the top. And the green line tracks the percentage held by the top 0.1%. Marked also on the chart are two political eras in American history: the emergence and reemergence of populism, a political strategy which targets the poor and middle class who feel their interests are disregarded by the connected and entrenched elite. Sorry, I can't see where my camera is. Until 1971, that trend was on its way out. The bottom 90% held 30% of the wealth and climbing, peaking at nearly 40%. Meanwhile, the top 0.1%, your Bill Gateses and your Jeff Bezos, fell to nearly 5% of the wealth. After 1971, however, the financial elite no longer had any checks on their cozy partnership with inflationary banks, and well-positioned traders could easily profit on the steady decline of the dollar. Of course, at the expense of those who bought, sold, and saved in the dollars, which are legally protected as currency and cannot simply be discarded in favor of sound or meaningfully scarce money. The data show that the slow death of the dollar has had a profound effect on American politics, and of course it is easy to turn anyone into the well-connected elite on the right side of the wealth transfer when making a campaign speech. Ballooning Medicare and Social Security payments, the majority of the $165 trillion unfunded obligations, are a favorite target of Republicans. The welfare state, as it's known, are favorite targets of conservatives who usually only find the national debt to be a problem when a Democrat is in office. But while broadening income disparities between high and low-level workers are easy talking points for Democrats. Again, Democrats these days talk a lot about the wage gap, about CEO pay, about the difference between the top 0.1% and the bottom 90%. Uh, as the data shows, both of these problems are caused by rampant inflation that has been enabled by the lack of a gold standard, by the lack of that check on government spending. As other sources of income are inflated away, sickly, elderly, and sometimes even lazy people increasingly turn to the government for help. So that explains the increases in Medicare, Social Security, various other welfare programs that Republicans are always talking about. Meanwhile, the rich and well-connected on the other side of the wealth transfer who have gotten out of their cash positions, out of the inflating dollars, and into sound money, into real assets like equity in companies, gold, silver, even some billionaires are into crypto now. I won't talk about whether that's a real asset. That's something you need to decide on for yourself. But the rich and well-connected on the other side of the wealth transfer, who receive the new money first and can spend it before prices rise, become fantastically rich on the backs of the poor. So the basic mechanics behind inflation is that the people who get the money first, who can spend it before prices rise, they get the benefit, the lion's share of the value from that inflated dollar. But as it passes through the economy and it leaves a trail of rising prices, the people who get it last, which is usually us, we have to pay the inflated prices. We do get those inflated dollars, but we also get inflated prices, and so we get a wash. And when we try to save, say if I put aside $500, $500 is not going to be worth as much in a few years as it is now. So when I try to save money, that gets inflated away, and that value goes directly to the people who receive the inflated money first, which is the rich and the well-connected. They become fantastically rich on the backs of the poor, which is, it is true. Both sides are right. Republicans are correct when they say that massive welfare spending is a problem. Democrats are correct when they say that a massive scheme on the part of the rich to become rich on the backs of the poor, in a way that they can't avoid. You know, if you don't want to make Jeff Bezos rich, and the only way that you could make him rich was to buy from Amazon, then you could just avoid buying from Amazon. But there are a lot of other ways that he gets rich off of your money. And both sides are right, but neither have the guts to acknowledge that their reckless promising and spending habits were what got America here in the first place. When they promise something is going to come, a new Medicare, Social Security payment, or some new public works that they're going to build, some infrastructure bill that there's a $3 trillion infrastructure bill that Joe Biden is currently considering. I'm not sure if that's been passed yet. Even the stimulus checks, the $1,400 stimulus checks that went out recently, that's actually something of a counterexample to that rich and well-connected thing, where we all got, or not all of us, but a lot more people got access to the inflated dollars before they spread into the economy. So a lot more people got a little bit richer. But the people who didn't, because there were people who didn't get stimulus checks, they pay the inflated prices without getting the inflated dollars first. So they are the victims of the stimulus checks. The reckless promising and spending habits of both Republicans and Democrats, who refuse to acknowledge the national debt problem, and who refuse to acknowledge that a gold standard would solve it, or a gold or a silver standard, really a standard that's based on a meaningfully scarce commodity. They refuse to acknowledge that would solve that problem. And their habits were what got America here in the first place. What? So, to wrap everything up, we're in a massive bind as a country. Uh, there, I don't remember the exact numbers, but there is something like $50,000 of national debt for every U.S. citizen, and that goes to $225,000 for every U.S. taxpayer. So that doesn't include the people who don't currently pay taxes. So I want the people in the audience to ask themselves, could I shoulder $225,000 in debt today? And I think for most of us, the answer is going to be a hard no. But that's what the government is going to expect you to do when they pass taxes in order to make up for that deficit. And with that kind of perspective, the national debt is a huge problem because it really does then have an effect on you. And that's what happened in 1971. It began this escapade of totally unchecked inflation and spending and debt that has grown into a snowball that now we're going to have a very hard time getting out of it. The national debt is actually 130% of national GDP. So if every single person in the United States produced was taxed at 100% of its value and sold, we still would have 30% of the national debt left over to pay next year. Again, that's just an idea of scale. I'm told that we do have a question. I'm ready to take questions now if anybody has any. I do hear one.
What do you think it will take to take care of our debt?
What do I think it will take? Well, I can tell you that it's going to be very, very painful. What again, that depends on what you mean when you say take care of the debt. Because there is always the option that the U.S. government just says, I can no longer pay this. I'm going to declare bankruptcy, which is going to be political upheaval across the entire world. And we would be lucky to remain as a nation after that, in my opinion. But it's a possibility, and it does take care of the debt. The other option, and probably the more sane option on the part of a politician, would be higher taxes. Much, much higher taxes. There was a point in about 1980 where the national debt was about 30% of GDP. So if people had been taxed at a flat 35% GDP, 35% flat tax across everybody, then the national debt could have gone to zero just in that year. Again, that would be a very painful tax. There are even European countries rarely pay 30-40% in taxes. I mean, maybe in the UK, but it's going to be a painful process. And that's why politicians today really don't want to confront it. They don't want to say, it's my problem. The people who live today have to deal with it. We can't keep passing it off to the next guy in office. We have to deal with it now. Before we can't control it anymore. You see in recent happenings in the bond market where the Federal Reserve has stepped in order to suppress the interest rate. Because if the interest rate goes up, even to a measly 3 or 4%, which in previous years, in the 80s, in the 60s, 3 or 4% interest would be nothing, but 3 or 4% today would absolutely crush the federal budget. We would have absolutely nothing left, no revenue except to service the debt. So we're in between a rock and a hard place. Either we inflate the dollar and keep interest rates low, or we pass some really, really high taxes and finally address the debt. And nobody wants to do either of those things. So I honestly couldn't tell you when or how the debt will be addressed. But I can tell you one of those two things has to happen. Another question.
Would higher taxes be a bad thing? Could we raise taxes campaigning that we can pay off debt, or will Americans just deny it?
Higher taxes are always a bad thing. I'm not saying higher taxes would be worse than the consequences of the debt. I don't know the source on this, but I read somewhere that $1 in federal revenue is equivalent to $2 or even $3 in lost value elsewhere in the economy. So, $1 of every dollar of federal revenue is going to multiply itself throughout the economy and cause, so higher taxes crush with a multiplier of 2 or 3 times, crush investment, they crush saving, they crush the economy in general. And so higher taxes are a bad thing. Everybody wants low taxes. But we have to bite the bullet, or we have to default. Again, I come back to that. We have to either say, I can no longer pay this, which is going to cause a lot of problems, or we're going to have to say, I'm going to pay this, and I'm going to pay this now. And that's going to cause a lot of problems. We have a lot of problems. We just have to deal with that. Another question.
China, is it going to call our debt? Do you agree?
Is China going to call in the debt? Interesting thing about that, China actually doesn't own very much. That's kind of a myth that's been perpetuated. China doesn't actually own. They offloaded, I believe it was in 2017, they dropped the last U.S. Treasury bond that they owned. So they don't have U.S. government debt. They might have U.S. corporate debt, I'm sure they do. But they don't have U.S. government debt because they don't trust the U.S. government to pay its debt. That should tell you again. There's a little bit of a political thing to that too, where Russia and China and their allies in the East have been trying to move away from the U.S. dollar as a reserve currency and set up their own system. So there's a political bent to that too, where they're trying to separate themselves from the U.S. dollar, but they don't actually own any of our debt, so they can't. The answer is no, they're not going to call in their debt. Maybe other countries will, but China themselves cannot. Another question.
Paper money has no worth right now. Agree or disagree?
Paper money has no worth. If you have a dollar on you, I don't actually have a dollar on me, but I want you to look, if you take a dollar out and you look down at the very bottom underneath of Washington's portrait, it says Federal Reserve Note. Now, previously, before the gold and the silver standards were abolished, here's a dollar. My brother has a $20 bill he's given to me. Actually, in the $20 bill, it's on top. But you see, it says Federal Reserve Note on the top here. And what that means is, what it would ordinarily say was something along the lines of, the bearer is entitled to $20 in gold coin at the U.S. Treasury. You could take this into the U.S. Treasury or an associated bank, put it down on the counter, and say, give me $20 worth of gold, please. And that's what their obligation would be. But this has no obligation associated with it. The only value that this paper money has is the belief that it can be traded for goods and services. But that belief is very fragile. We've seen multiple times, just in this presentation alone, where the Continentals and the greenbacks and the demand notes and or the demand notes and the greenbacks were the same thing. The Continentals, the demand notes, various other forms of U.S. currency, the state's bills of credit also endured massive inflation during the Revolutionary War. They have no intrinsic worth. That is correct. Gold and silver, hard money, have intrinsic worth because they aren't used entirely in monetary purposes. They also have non-monetary use. So there's at least that baseline of non-monetary value that they could be used for, even if they fell to zero in the money sense. But if this falls to zero in the money sense, which it eventually will, all fiat currencies throughout history go to zero. And that's a fact. But if this fell to zero, the only thing I could do with this is maybe start a fire. Or make handbags with it like they do with the bolivars in Venezuela. This has no intrinsic value. This, to me, if this were actually my money, the only thing this would be was a vehicle to acquire hard money, real money, which is this Liberty half dollar. This is real money because it contains a non-monetary good that is used in real applications, unlike this. And so no, paper money does not have any worth if it is not at least exchangeable, reliably exchangeable, for something that does have real worth. This is a currency. This is money. I was dreading getting this question, but we have a question that says, is it smart to invest in Bitcoin? That is... I'm going to try to keep the answer short, and I'm going to say that yes, if you have a remarkable appetite for risk, because the market for cryptocurrencies is only about 10 years old, it's still a very fledgling market and a lot can happen. And they're very volatile. Not as volatile as they used to be, but they're still very volatile. You have to have a stomach of steel to ride the dips and the highs and not buy or sell based on emotion. It can be smart for people who like to have a very high risk portfolio to invest in Bitcoin. And I won't tell you a dollar amount that you should either. If you want to preserve your wealth, go with the safe option. If you want to make a lot of money, if you want to be an early adopter, if you want to get in on something that could be even bigger than it is now, yes, invest in Bitcoin. But if you want to preserve your wealth and use something that has a track record for thousands of years as real money, then buy gold and silver and leave the crypto to people who are less risk averse. I hope that answered your question. Do we have any more? I'm going to wait 30 to 60 seconds for any more questions, and if we don't get any more, then I guess that's the end. But we'll see if anybody else has any more questions. We got another question. Okay, somebody in the chat said that I've heard that XRP, or Ripple, is better than Bitcoin. Um, I can tell you that I haven't done that much research on XRP. I did hear that it had been delisted by lots of major exchanges because of a lawsuit by the SEC towards its creators. Um, I can tell you that XRP is centralized in its creation, in its distribution, and in the way that its chain is verified. It is not. It does not carry a lot of the same attributes that made Bitcoin initially attractive and Ethereum initially attractive, because it is a centralized coin and it can be printed in infinite quantities. So if it's controlled by a central authority and can be printed in infinite quantities, in my eyes, it's no better than fiat. It is essentially fiat. It might have technological applications. I know for a fact Ethereum can be printed in infinite quantities. The developers are actually working on a way to stem that inflation, several ways to stem that inflation. And Ethereum has technological applications. There's people building thousands of applications on the Ethereum blockchain, taking advantage of its decentralized nature to create video sharing apps and link federators like Reddit and thousands of things that would benefit immensely from a decentralized structure that Ethereum makes possible. Um, Again, I'm not talking about XRP anymore, but uh, like I said before, cryptos can be useful. Cryptos can be good, and XRP, in my opinion, is not better than Bitcoin. Bitcoin is leagues better than any centralized, infinitely printed coin. But that's just my opinion. Do your own research. Everybody here should do their own research. Don't take my word as gospel. Don't take my sources as gospel. I did have a concerned reader or a concerned listener come to me after the last presentation concerned about the validity of my sources, and I talked to him at length as best I could to explain why my sources were valid. And I'm perfectly willing to do that with anybody in the chat. Two questions.
Short one is how do you invest in gold and silver? The long one is can you explain brief about GameStop?
Okay, last two questions. Number one, how do you invest in gold and silver? Number one way, find a local gold and silver shop. I would not recommend going to a pawn shop, but I have one just a few miles away from me. It's called Golden Eagle Coins and Collectibles, and they sell bullion, gold and silver in a variety of forms that make it. They will probably in-person dealers will probably have the lowest premiums because, of course, they're going to charge something over spot price so that they can make a profit. Versus online dealers who are going to charge a little bit more, but they also have a much greater selection, and you might also have to pay shipping. It depends on how much you actually order at a time. Online dealers like AppMex, JM Bullion, depending on where you live, in other countries there are you can buy from the Royal Mint in the UK, from the Canadian Mint, the Perth Mint, anywhere. But online dealers exist, and I would recommend anybody who wants to invest online should go to findbullionprices.com. That's findbullionprices.com, and they aggregate all of the best deals on gold and silver on the internet and make it really easy for you to find low premiums on the items of gold and silver that you want to buy. So that's how I've been investing through 2020 and 2021, is buying it online and getting it shipped to me because it's just more convenient. Okay, last question. Briefly explain what happened to GameStop. Now, in brief, hedge fund managers had been directing their uh, hedge funds had been directing their traders to put what are called short sales on GameStop stock. And a short sale is where you sell a share that you own, wait for the price to fall, and buy it back. But specifically, you borrow it from someone else, sell it, wait for the price to fall, and then buy it back and give it to that person, and you pocket the difference. So, say that the price of the share was $15, and I borrowed it, waited for it to fall to 10, or borrowed it, sold it, waited for it to fall to 10, bought it back, and then gave it back to you. I pocket the $5 difference. So it can be very lucrative, especially when you combine it with their shadier practices like spreading bearish news about the company. GameStop, in particular, was already kind of on its way out because the business model was kind of old. Uh, but they created so many of these short sales that they had the short interest, or the amount of short sales that existed. There were 140% of existing stock shares promised to people who had had their shares borrowed from them. So that created a prime opportunity for retail traders on the Reddit forum Wall Street Bets to buy up all of the GameStop float, the amount that was circulating, that the short sellers were depending on being there, and they bought it and they bought it and they sucked it all up. And then when the short sellers went to go buy their stuff back, there wasn't any to buy, and they had to keep asking higher and higher and higher prices until the Wall Street Bets people finally sold. And not all of them have sold. It's still an ongoing thing. I wouldn't say that it happened. It's still happening. But briefly, what happened to GameStop was that the hedge funds got caught in a very awkward position that they put themselves in by a bunch of retail traders who were loosely cooperating, and the retail traders made a bunch of money from the hedge funds, and that process is still going on. The price is still very volatile because the amount of stock that's out there is still very small. But briefly, that's what happened to GameStop. Did we get any more last-minute questions? Okay, no more last-minute questions. It has been a pleasure talking with you all. Well, I guess I only talked to myself, and I'm talking to you all. Thank you very much for tuning in, and we will see you right here next Saturday at 8 p.m. Thank you very much.